When central bankers sleep at night, they dream of 2008. They dream of the moment when they rode to the rescue, slashed interest rates to zero, and printed money until the crisis passed. They dream of being heroes who saved the global economy with bold action and unlimited liquidity, but dreams have a way of becoming nightmares, and the playbook that worked 18 years ago is about to become their worst enemy. The world has changed in ways most people don't understand. The financial system that central banks rescued in 2008 was broken, but it was still fundamentally the same system that had existed for decades. Banks lent money, people borrowed it, and when things went wrong, you could cut rates and flood the system with cash. It was messy, it was painful, but it worked. The patient survived. Today, we're dealing with a completely different beast. The global economy is addicted to cheap money, drowning in debt levels that make 2008 look quaint, and facing structural problems that no amount of money printing can solve. Here's what they won't tell you on the evening news. Central banks aren't preparing for another 2008. They're preparing for something far worse. And their new strategy isn't about saving the economy. It's about controlling it in ways that would have been unthinkable just a few years ago. The tools they're building, the policies they're testing, and the powers they're accumulating point to one terrifying conclusion. When the next crisis hits, they won't just be managing money, they'll be managing you. Let's start with the obvious problem: interest rates. In 2008, the Federal Reserve had room to maneuver. Rates were sitting at over 5% when the crisis began, giving them plenty of ammunition to cut. They slashed rates from 5.25% all the way down to zero, providing massive stimulus to the economy. Today, that luxury doesn't exist. After years of ultra-low rates, central banks around the world are trapped near zero with nowhere left to go. The European Central Bank has been running negative rates for nearly a decade. Japan has been stuck in this trap even longer. When rates are already at or below zero, you can't cut them to fight the next recession. But the interest rate problem is just the surface. Underneath lies something far more dangerous: debt. Global debt has exploded since 2008. Reaching levels that dwarf anything in human history. In 2008, total global debt was around $180 trillion. Today, it's over $300 trillion and climbing. Governments borrowed to fund stimulus packages. Corporations loaded up on cheap debt to buy back shares and pay dividends. Households stretched themselves thinner than ever before to buy homes and cars they couldn't really afford. Everyone became addicted to cheap money, and now the dealer is running out of product. This debt explosion created a paradox that haunts central bankers. They can't raise rates without triggering mass defaults and financial collapse. But they can't keep rates low forever without destroying their currencies and fueling dangerous bubbles. They're trapped in a box of their own making, and every month that passes makes the walls close in a little tighter. The 2008 playbook assumed you could flood the system with money and eventually withdraw it when things stabilized. That assumption is now dead. The economy has become so dependent on artificial support that removing it would cause immediate collapse. Meanwhile, inflation has returned with a vengeance. For years after 2008, central banks printed trillions and inflation barely budged. They began to believe they had conquered it permanently. Then came the pandemic, supply chain disruptions, and a rude awakening. Inflation roared back to levels not seen in 40 years, forcing central banks to choose between fighting rising prices and keeping their debt-addicted economies alive. They chose to fight inflation, raising rates aggressively, but the underlying problems remain. The next time crisis strikes, they'll face the nightmare scenario of needing to print money while inflation is already running hot. But here's where the story gets truly frightening. Central banks aren't just admitting their old tools are broken, they're building new ones. And these new tools aren't designed to work within the free market system, they're designed to replace it. The first weapon in their new arsenal is something called central bank digital currencies. CBDCs aren't just digital versions of paper money, they're programmable money that gives central banks unprecedented control over every transaction in the economy. Imagine money that expires if you don't spend it fast enough. Imagine money that can't be used to buy certain goods or services. Imagine money that tracks every purchase you make and reports back to authorities in real time. That's not science fiction. That's the stated goal of CBDC programs being tested, from China to Sweden to the United States. They're telling us it's about efficiency and convenience, but the real purpose is control. When the next crisis hits, they won't need to rely on banks to distribute stimulus. They'll deposit it directly into your digital wallet, with strings attached. The second weapon is direct government spending funded by central bank money creation. They call it modern monetary theory, but it's really just printing money to fund whatever politicians want to spend on. During the pandemic, we got a preview of this system. Central banks bought government bonds while treasuries sent checks directly to citizens. The pretense of independence between fiscal and monetary policy evaporated overnight. When the next crisis comes, this marriage of convenience will become permanent. Central banks will fund massive government programs, not through traditional borrowing, but through direct money creation on a scale that makes 2008 look like pocket change. The third weapon is the most insidious: financial repression. When your currency is dying and your debt is unpayable, you don't default. You force your citizens to accept negative real returns on their savings. You cap interest rates below the rate of inflation. You restrict capital flows to prevent money from fleeing. You mandate that pension funds and insurance companies buy your worthless bonds. It's theft disguised as policy, and it's already happening in countries around the world. These aren't theoretical possibilities. They're active preparations happening right now. The Bank for International Settlements, the central bank of central banks, has published detailed studies on CBDCs. The Federal Reserve has partnered with the Massachusetts Institute of Technology to test digital dollar technology. The European Central Bank has launched a digital euro pilot program. China has already rolled out its digital yuan to hundreds of millions of citizens. The infrastructure for financial control is being built while everyone argues about inflation and interest rates. What makes this moment different from 2008 is that central banks know their old tools are exhausted. They've spent the last 15 years admitting as much in their own research papers and policy speeches. The quantitative easing programs that saved the day in 2008 are now permanent fixtures of monetary policy. The emergency measures have become normal operations, and everyone understands that the next crisis will require measures that make the previous emergency tools look conservative by comparison. The banking system itself has changed in ways that make traditional monetary policy less effective. Shadow banking has exploded in size, creating financial institutions that operate outside traditional regulatory frameworks. Cryptocurrency markets have introduced new forms of money that central banks don't control. Private equity and hedge funds have grown so large they can move markets independently of traditional banks. The neat, controlled system that central banks rescued in 2008 has been replaced by a chaotic web of interconnected players who don't follow the old rules. Meanwhile, geopolitical tensions are fracturing the global financial system that enabled the 2008 response. When Lehman Brothers collapsed, central banks around the world coordinated their response, cutting rates and printing money in unison. Today, the United States and China are locked in economic warfare. Russia has been cut off from the Western financial system. The European Union is struggling with internal divisions over fiscal policy. The next crisis won't be met with coordinated action. It will be met with every major power trying to export their problems to someone else. This is why central banks are building their new playbook. They know the next crisis is coming. They know their traditional tools won't work. And they know that maintaining control will require methods that previous generations of central bankers never imagined using. The question isn't whether they'll implement these new strategies. The question is whether the rest of us will recognize what's happening before it's too late. The signs are everywhere if you know how to read them. In 2019, the Federal Reserve's own research division published a paper titled "Monetary Policy When the Equilibrium Real Rate is Low." Buried in the academic jargon was a stark admission: traditional monetary policy had reached its limits. The paper outlined scenarios where central banks would need unconventional tools to maintain economic stability. Translation: they were already planning for a world where cutting interest rates wouldn't be enough. That same year, the Bank of England released a working paper exploring the macroeconomic implications of central bank digital currencies. The authors didn't just analyse the technical feasibility of digital money. They modelled how CBDCs could be used to implement negative interest rates more effectively than traditional policy tools. Think about what that means. They weren't just studying digital currencies as a convenience. They were studying them as weapons against savers who might try to escape negative rates by holding cash. The European Central Bank went even further. In 2020, Christine Lagarde announced that the institution was exploring a digital euro that would give policymakers more direct control over monetary transmission. The language was carefully chosen, but the meaning was clear. Instead of relying on banks to pass along policy changes, central banks wanted direct access to every wallet, every account, every transaction in the economy. The middleman was being eliminated not for efficiency, but for control. But perhaps the most revealing document came from the Bank for International Settlements in 2021. Their annual economic report included a chapter titled CBDCs, an opportunity for the monetary system. The paper didn't just advocate for digital currencies. It outlined how they could be programmed with smart contracts that would automatically enforce policy decisions. money that could turn itself off, money that could redirect itself to approved purchases, money that could tax itself based on how long you held it. The authors called it programmable money. The rest of us should call it what it is, the end of financial privacy. These aren't isolated academic exercises. They're coordinated preparation for a new form of monetary control that makes the 2008 response look primitive by comparison. Central banks understand that the next crisis will require tools that bypass traditional financial institutions entirely. They can't rely on banks to distribute stimulus when the banks themselves are insolvent. They can't depend on market mechanisms when markets have ceased to function. So they're building systems that eliminate both banks and markets from the equation. The testing phase is already underway. China's digital yuan isn't just operational, it's mandatory for government employees in major cities. Citizens receive their salaries in digital currency that tracks every purchase, expires if not spent quickly enough, and can be programmed to prevent certain transactions entirely. The Chinese Communist Party calls it financial modernization. But watch what happens to dissidents whose digital wallets suddenly stop working, and you'll understand the real purpose. The Bahamas launched the world's first fully operational CBDC in 2020. The sand dollar was marketed as a solution to banking access in remote islands. But the fine print reveals something more sinister. Every transaction is recorded permanently. The central bank can freeze accounts instantly without court orders, and the currency can be programmed to restrict purchases based on government priorities. A hurricane relief fund that can only buy approved supplies. Tourism payments that automatically convert to local spending. It's social engineering disguised as monetary policy. Sweden's Riksbank has been testing the e-krona since 2017 with trials expanding every year. The stated goal is replacing physical cash as Swedish society goes increasingly digital. But the technical specifications reveal broader ambitions. The e-krona includes functionality for automatic tax collection, negative interest rate implementation, and what officials call dynamic monetary policy transmission. In plain language, they're building money that can be controlled in real time based on economic conditions and policy objectives. Even in the United States, where privacy concerns run deeper, the infrastructure is being assembled. The Federal Reserve's FedNow payment system, launched in 2023, creates the backbone for instant, trackable transactions across the entire banking system. Officials describe it as modernizing payment infrastructure, but examine the technical architecture, and you'll find the foundation for a future digital dollar that could bypass traditional banking entirely. When the next crisis hits, the Fed won't need to beg banks to lend. They'll deposit money directly into citizen accounts and control how it's spent. The legal framework is being prepared alongside the technology. The European Union's Markets and Crypto Assets Regulation, passed in 2023, doesn't just regulate cryptocurrencies. It establishes the legal precedent for governments to control all forms of digital money, including future CBDCs. The legislation includes provisions for transaction monitoring, automatic reporting to tax authorities, and emergency powers that can freeze digital assets during financial crises. It's not regulation, it's preparation for takeover. In the United States, the Stable Act and other proposed legislation would require all digital currencies to receive government approval and comply with banking regulations. On the surface, it looks like consumer protection. But read the technical requirements and you'll see they're designed to make independent digital currencies impossible while clearing the path for government-controlled alternatives. Private cryptocurrencies would be regulated out of existence, leaving only central bank digital currencies as viable options. The timing isn't coincidental. These preparations are accelerating because central bankers know something the general public doesn't. The mathematical impossibility of the current system is becoming undeniable. Global debt to GDP ratios have reached levels that historically precede either hyperinflation or deflationary collapse. Productivity growth has stagnated across developed economies, making it impossible to grow out of debt burdens. Demographic trends in major economies mean fewer workers supporting more retirees, straining government finances beyond breaking points. The derivatives market, which nearly collapsed the global system in 2008, has grown exponentially larger and more complex. The Bank for International Settlements estimates the notional value of outstanding derivatives at over $600 trillion. That's not a typo. $600 trillion in financial instruments whose value depends on underlying assets worth a fraction of that amount. When these contracts start unwinding, no amount of traditional monetary policy will contain the damage. Real estate bubbles have inflated far beyond 2008 levels across major economies. Housing prices in Canada, Australia, and parts of Europe have reached multiples of income that make the American subprime crisis look modest. China's property sector, which represents roughly 30% of their economy, is already showing signs of systemic failure. When these bubbles burst simultaneously, the deflationary shock will overwhelm any central bank's ability to respond with conventional tools. The corporate debt market has become a house of cards built on artificially low interest rates. Zombie companies that should have failed years ago have survived by rolling over debt at near zero rates. When borrowing costs rise or credit markets freeze, mass bankruptcies will follow. The unemployment and social disruption will require government intervention on a scale that makes pandemic spending look conservative. And that intervention will require new forms of money that can be distributed and controlled directly by authorities. Central banks aren't just preparing for economic crisis, they're preparing for social crisis. The combination of inflation, unemployment, and financial collapse that accompanies monetary system breakdowns inevitably leads to civil unrest. Digital currencies aren't just about controlling money, they're about controlling behavior. Programmable money can reward compliance and punish dissent more efficiently than any police force. When your ability to buy food depends on a government-controlled digital wallet, protest becomes a luxury few can afford. The international monetary system is fracturing in ways that make coordinated crisis response impossible. The dollar's role as global reserve currency is being challenged by China, Russia, and other powers seeking alternatives to American financial control. But instead of strengthening the dollar through sound fiscal policy, American authorities are preparing to maintain dominance through technological control. A digital dollar that tracks every transaction globally would provide surveillance capabilities that physical cash never could. This is why the 2008 playbook is obsolete. The problems are too large, the tools are too weak, and the political constraints are too tight for traditional monetary policy to work. Central banks need direct control over money creation, distribution, and spending to maintain their grip on power. They need to bypass banks, markets, and democratic institutions that might resist their policies, and they need to implement this control before the next crisis exposes their impotence. The new strategy isn't about saving the economy. It's about replacing it with something more manageable, more controllable, and ultimately more profitable for the institutions and individuals who understand what's coming. Those who recognize the transition early will position themselves accordingly. Those who trust in the old system will find themselves trapped in the new one. The evidence isn't hidden in classified documents or secret meetings. It's sitting in plain sight in the research papers, policy speeches, and pilot programs that central banks publish openly. They're not hiding their intentions because they don't think anyone is paying attention, and for the most part, they're right. Take the Federal Reserve's own research on what they call going direct. The concept is simple and terrifying. Instead of working through banks to stimulate the economy, central banks would bypass financial institutions entirely and deposit money directly into citizen accounts. They tested this during the pandemic with stimulus checks, but that was just the beginning. The infrastructure they're building would allow instant targeted money distribution to specific groups, regions, or even individuals based on real-time economic data and political priorities. The Bank of Japan has gone further, publishing detailed studies on helicopter money. Literally dropping cash from helicopters was economist Milton Friedman's metaphor for direct money creation. But the Japanese version isn't metaphorical. They're designing systems where central banks could credit citizen accounts instantly during crises, bypassing government budgets, legislative approval, and traditional banking entirely. The money would come with expiration dates to force immediate spending and geographic restrictions to prevent capital flight. The Swiss National Bank has been quietly testing what they call conditional cash transfers since 2022. Citizens in select regions receive digital payments that can only be spent on approved goods and services. The program is marketed as environmental policy, money that can't buy fossil fuels or high-carbon products. But the technical infrastructure is identical to systems that could restrict any category of spending during future crises. Food rationing without ration cards, luxury restrictions without legislation, social control through programmable scarcity. These aren't theoretical experiments anymore. They're operational tests of financial control systems that will be deployed when traditional monetary policy fails completely. And that failure is approaching faster than most people realize. The mathematics are brutal and undeniable. Global debt service now consumes over 40% of government revenues in major economies. Corporate debt-to-equity ratios have reached levels that historically precede mass defaults. Household debt burdens have exceeded 2008 peaks across multiple developed nations. But the most dangerous development isn't visible in debt statistics or inflation numbers. It's the psychological transformation happening inside central banks themselves. The generation of economists who lived through the gold standard, who understood the discipline of sound money, who believed in market mechanisms, they're gone, replaced by technocrats who see the economy as a machine that can be optimized through data analysis and algorithmic control. These new central bankers don't just believe they can manage business cycles. They believe they can eliminate them. They think recessions are policy failures rather than natural economic adjustments. They're convinced that with enough computing power, enough data, and enough control over money flows, they can create permanent stability. It's the same technocratic arrogance that led to the 2008 crisis, but amplified by 15 years of seemingly successful intervention. The problem is that economies aren't machines. They're complex adaptive systems that require failure, bankruptcy, and creative destruction to remain healthy. When central banks prevent these natural processes, they don't eliminate instability. They concentrate it into larger, more devastating collapses. Every business they keep alive through cheap money is a zombie that consumes resources without creating value. Every bubble they inflate to prevent deflation creates bigger problems down the road. Every crisis they postpone becomes more severe when it finally arrives. The current system has reached the mathematical point where postponement is no longer possible. Debt levels require interest rates to remain near zero permanently, but zero rates fuel asset bubbles that threaten financial stability. Inflation requires higher rates to control, but higher rates would trigger mass defaults and recession. Central banks are trapped between deflation and hyperinflation with no sustainable path forward. This is why they're abandoning traditional monetary policy in favor of direct economic control. When market mechanisms stop working, they plan to replace markets with algorithms. When banks become insolvent, they'll bypass banks entirely. When currencies lose credibility, they'll create new forms of money backed by surveillance and coercion rather than trust and value. The transition won't happen overnight. It will unfold gradually through a series of crises that require ever more extreme responses. A banking panic that justifies temporary deposit freezes. A currency crisis that necessitates capital controls. A recession that demands direct money distribution. Each emergency measure will become permanent infrastructure for the next level of control. The pattern is already visible in smaller economies that serve as testing grounds. Cyprus confiscated deposits during their 2013 banking crisis, establishing the precedent for bail-ins across Europe. Greece implemented capital controls that lasted for years, proving that financial restrictions could be maintained indefinitely in developed economies. Lebanon froze bank accounts in 2019 and still hasn't fully restored access, demonstrating how quickly modern banking systems can be shut down. So, these weren't isolated incidents. They were proof-of-concept trials for policies that will be implemented globally when the next systemic crisis hits. The legal frameworks have been established. The technical infrastructure has been tested. The public has been conditioned to accept emergency measures as temporary necessities. All that remains is the trigger event that justifies deployment. That event is approaching because the underlying problems are accelerating rather than resolving. Commercial real estate markets are collapsing as remote work makes office buildings obsolete. Regional banks are failing as rising rates destroy the value of their long-term bond portfolios. Corporate bankruptcies are spiking as companies can no longer refinance debt at affordable rates. Each failure increases stress on the entire system. The international dimension makes everything worse. When the dollar was unquestionably dominant, the Federal Reserve could export inflation globally and import deflation as needed. Other central banks had to follow American policy, whether it suited their economies or not. But that era is ending as alternative payment systems, currency arrangements, and trade networks reduce dollar dependence. China's Belt and Road Initiative isn't just about infrastructure development. It's about creating trade networks that bypass dollar-denominated transactions. Russia's exclusion from SWIFT accelerated the development of alternative payment systems that reduce American financial control. Saudi Arabia is accepting yuan for oil payments, breaking the petrodollar system that has supported American monetary dominance for 50 years. As dollar hegemony weakens, the Federal Reserve loses its ability to manage global liquidity cycles. But instead of accepting this reality and implementing sound fiscal policies, American authorities are doubling down on technological control. A central bank digital currency that tracks every transaction globally would provide surveillance capabilities that physical dollars never could. Financial sanctions could be implemented instantly without international cooperation. Capital flight could be prevented through programmable restrictions rather than regulatory enforcement. This is the real purpose of the new monetary infrastructure being constructed. Not economic efficiency or crisis management, but the preservation of centralized control as traditional power structures break down. The question isn't whether these systems will be deployed. The question is whether enough people will recognize what's happening and take protective action before deployment becomes universal. The window for preparation is closing rapidly. Every month that passes sees more restrictions on alternative assets, more surveillance of traditional banking, and more integration of digital payment systems that can be controlled centrally. The infrastructure of financial freedom is being dismantled, while the infrastructure of financial control is being perfected. Those who understand the transition have time to position themselves outside the new system. Those who trust that central banks will somehow return to the policies of previous decades will find themselves trapped inside a monetary prison of unprecedented scope and sophistication. The choice is becoming binary: freedom or security, independence or control, privacy or convenience. Central banks are betting that most people will choose security, control, and convenience. They're probably right. The question is which side of that bet you want to be on when the next crisis forces everyone to choose. History shows us that monetary systems don't reform gradually. They collapse suddenly and get replaced by something completely different. The 2008 playbook worked within the old system. The 2026 playbook is designed to replace that system entirely. And replacement, not reform, is what's coming. The writing is on the wall for anyone willing to read it. Central banks have abandoned the pretense that they can save the current system. Instead, they're building its replacement. The 2008 playbook of cutting rates and printing money is dead, killed by the very debt addiction it created. What's coming next isn't another rescue operation. It's a complete transformation of how money works, who controls it, and what freedom means in a digital economy. The evidence isn't hidden in conspiracy theories or classified documents. It's sitting in plain sight in research papers, pilot programs, and policy speeches. Central bankers are telling us exactly what they plan to do. They're going to bypass banks, eliminate cash, and program money to enforce their priorities. They're going to fund governments directly, control spending digitally, and monitor every transaction in real time. They call it modernization. History will call it what it is: the end of monetary freedom. The transition is already underway. Every crisis will accelerate it. Every emergency will justify another permanent expansion of control. And every person who trusts the old system to protect them will discover too late that the old system no longer exists. History doesn't repeat, but if you ignore its warnings, it will crush you all the same. The question isn't whether this transformation will happen. The question is whether you'll recognize it in time to protect yourself. If this opened your eyes to what's really coming, hit subscribe. The future belongs to those who see it clearly.